and got into, foreign currencies or gold bullion. I mean, you could have got into gold to protect yourself. In 1972, gold was probably $120 an ounce. It went up to 800. So you could get into non-dollar assets to protect yourself from inflation and the devaluation of the dollar. And I think this decade is going to be far worse than the 70s, because the money that was created during the 1990s and 1980s, the rate at which the Greenspan grew the money supply, or the inflation, was far more substantial. In the 1960s, the central bank inflated to finance the war in Vietnam, the war on poverty, the Great Society. There was a tremendous expansion of money. Initially, that expansion fed into a stock market bubble that we had in the 60s. When it burst, we had the aftermath, and then we had the inflation move into consumer prices. This time around, we had a bigger growth in the money supply, which spawned an even bigger bubble, and it's going to be a bigger bust, and you're going to see these foreign currencies, gold prices moving up much higher than they did in the 1970s. And and there's still time for people to get out. I mean, there's still plenty of time to get rid of your dollars and to get into sound foreign currencies, and not only stocks. I'm buying government bonds, Australia, government bonds, real estate investment trusts in New Zealand, good income, safety, and you're protected from inflation.
Is this going to be a more widespread problem now because more of us are invested in stocks, either through retirement funds or various other...
Yeah, I mean, a lot of people are going to be devastated by this. I mean, people look at their retirement accounts and think they have wealth there. They don't. There's a number on a piece of paper, but these stocks that they have are not paying dividends. I mean, if you're going to go to retire and you have a stock portfolio, the conventional wisdom is, I'm going to keep my money in stocks, and then when I retire, I'll sell my stocks and buy some bonds to get income. But you've got to ask yourself, sell them to who? Somebody has to be there to buy those stocks from you. That's not going to happen. The stocks that my clients own, when they retire, they never have to sell them, because the dividends are providing the return. So you can buy the stock and forget it, because you're getting dividends. When you own a stock, you own a percentage of a company. And the way you get compensated is you share in the earnings through the dividends. If you're not getting any dividends, you're just gambling. All you're doing, if you buy a stock without a dividend, you're not investing. You're purely speculating on the price. And if you're trying to invest for retirement, you don't want to speculate. You're not gambling. So people think they have money for retirement. They don't. It's just a giant Ponzi scheme. Just like people who looked at their internet portfolios 3 years ago might have assumed they had a lot of money. They didn't have anything. And the same thing, you can have a portfolio of blue chip stocks. Believe me, these stocks could lose 80% of their value or more by the time you go to retire. So now is the time that people need to really get rid of these shares while there's still people foolish enough to buy them. Because obviously we all can't get out of the market.
Right.
Only a few people can get out, because we need the masses to hold the market up. If 5% of the people try to get out of the market, it would just implode. So only a few people are going to be able to get out. And you want to be one of those few. You don't want to be one of the people stuck at the end.
And that's the problem. We want to buy low and sell high, as it were, but the problem is we don't know what low is low and we don't know what high is high either.
Well, right now, things are high. And what people were doing in the mania was buying high and hoping to sell higher. But if you want to buy low, you don't want to buy a stock unless the dividend yield on that stock exceeds the bond rate. Because when you own stock, you're taking risk. You're taking more risk than the bondholder. The bondholder is paid interest. His interest is low because he's not taking a lot of risk. Yeah. When you're a stockholder, you get a dividend. And your dividend needs to be higher than the interest on the bond because you're taking more risk. You're the residual claim on those assets. And a lot of people are going to find out, I think a significant percentage of the Fortune 500 is going to go bankrupt. Balance sheets are a mess. And companies are leveraged to the hilt with a lot of short-term debt. And when interest rates rise, and they will rise, a lot of companies are going to go under. And it doesn't mean they're going to disappear from the scene. It means that the ownership is going to transfer from the people who own the stock to the people who own the bonds. And so people who own equity, they're taking substantial risks, and they don't realize it. And you need to be compensated for that risk, and the way you get compensated is dividends. But Wall Street has brainwashed the public into thinking they don't need dividends.
Okay, I'm going to stop you again. Let's go ahead and take another break. Stay with us. Welcome back. I think it's going to be a hard sell for people to convince them to get out of U.S. interests and into overseas interests, especially today. We've had a lot of, pro-USA things going on. Plus, I think people like to have something tangible, too. I want to invest in something I can see that's, in my neighborhood mall or something like that. How hard of a sell is it to get people to invest overseas?
Well, it's not as difficult as it used to be. Years ago, when I was talking to my clients about the mania in the market in 1998, 99, 2000, it was a lot more difficult for me to convince people that it was a mania and that they needed to get out. But now, as people can see, my predictions, I've never bought an internet stock. In fact, I haven't bought a technology stock since the early 90s. I haven't bought any. I was out, probably by the mid-90s. But my advice to clients, I predicted that 90% of all internet stocks would go bankrupt, that the remaining 10% that didn't go bankrupt would fall by 99%. And I think that actually prediction was conservative because it ended up being worse than that. But it was more difficult. But now that people can see these stocks blow up, you can look at an Enron, for example, with every single major Wall Street firm analyzing these companies with their buy ratings, yet they can let them go to nothing. And people think it's an isolated case. It's not an isolated case. Just yesterday, 4 major brokerage firms downgraded WorldCom. WorldCom shares have fallen from $60 down to $4 before they go from a strong buy to a hold. I'd like to ask the analysts, hold what? There's nothing left. But WorldCom is where it was 10 years ago, but it's never paid a dime in dividends. No investor who bought WorldCom has benefited from the fact that the stock was at 60, unless, of course, they sold. But that's benefiting as a speculator, not an investor. So I think as more and more people are starting to see that Wall Street is conning them, and hey, if these guys can be so wrong about Enron, so wrong about WorldCom, so wrong about Cisco or any of these companies that were so heavily touted, why can't they be wrong about the whole thing? About what they're saying about the economy, about what they're saying about the market. And they are wrong. All they're trying to do is sell stocks. And Wall Street wants to keep the market high so they can sell more stock, get better fees. They manage money, and their money management fees are based on how much money they're managing. So if they can artificially inflate the value of their money under management, they get bigger fees. It doesn't matter if by the time you need the money, it's gone. They've already made their fees. And these mutual fund managers, the way they're compensated, if you've got your money in mutual funds, your mutual fund manager, he doesn't care if you make any money. All he cares about is, does he outperform his benchmarks? So if the benchmark is loaded up with a bunch of overvalued stocks, he has to buy those stocks in case they keep going up. It doesn't matter if eventually the bubble bursts and they collapse, because he's going to lose just like everybody else. I remember years ago, I think it was Vinnick who was managing the Fidelity Magellan Fund. He made the mistake of thinking the stock market was overvalued, so decided to sell some stocks and buy bonds, and he got fired because he underperformed because the market kept going up. So if you're an investor, you don't care about short-term performance because it means nothing.
Right.
You care about the long-term performance, but your mutual fund manager, he doesn't care about that. So nobody is looking out for your interest. Companies are just trying to jack the share prices up so they can sell. Wall Street wants to keep the price up. If you want to, if you're concerned about your money and your safety, you've got to, take charge of that. And you've got to think for yourself, and you've got to look at things rationally. And you've got to look at these stocks trading at these ridiculous multiples and realize that you can't buy them. You've got to look around the world and find where there is value, where you can invest and get a reasonable return given the risk that you're taking. And you've got to look at, the problems of the United States. And, a lot of people think, getting out of the market, that's panicking.
Right.
It's not panicking to sell an overvalued market. It's a rational decision that you make. When people are going to panic, and they will panic, is 2 or 3 or 4 years from now, when interest rates are, 12% or 14%, unemployment is 10%, or who knows how high it is, and the market is extremely low, maybe the NASDAQ is 500 or 300, and now people are selling. That's when they'll be panicking.
Right.
And that's when I'll be buying, and my clients will be repatriating their euros and their Swiss francs and their Aussie and New Zealand dollars, and we'll be coming back into the U.S. to prepare for the next bull market that might be 5 or 10 years down the line. But in the meanwhile, we'll be able to buy these stocks that are still around with good dividends at low prices and wait for the next mania where we can sell out to the next group of suckers.
Good. All right. I'm going to stop you again. Let's take one more break. Stay with us.